Good afternoon. Thank you for joining us for today's webinar, What is Life After Coronavirus? New Tax-Related Provisions for Increased Cash Flow, presented by Ray & Associates, a top 100 regional CPA and business consulting firm with offices across Ohio. My name is Imani Fields, and I'll be moderating today's presentation. Before we get started, there are a few housekeeping items to cover. First, if you have any questions during today's presentation, you may enter them into the chat box on your screen. We will try to answer as many questions as we can at the conclusion of today's presentation. However, to be respectful of your time, we know that we will not be able to get to them all. Therefore, following today's webinar, we will review all questions and send out the answers via email as soon as we can. When you receive this email, you will also receive the recording of today's presentation, as well as a link to participate in a very short evaluation. Please take a few minutes to share your thoughts about the presentation as a whole, the information provided, and our presenters. Your feedback is important to us as we determine future webinar topics related to the current COVID-19 crisis. Also, if you'd like a copy of today's slides, you will find that they're available in the handout section of the webinar dashboard on your computer screen. Today's webinar will be given by Christopher Axene and Greg Speece. A principal at Ray & Associates, Christopher Axene has over 25 years of experience in the accounting industry. He oversees the federal tax planning practice for the firm and also provides complex tax transaction planning and reviews, choice of entity planning, IRS audit representation, and tax due diligence for M&A transactions. Christopher is also responsible for the tax practice quality control program. Greg Speece is a principal at Ray & Associates working in tax services. Greg brings more than 10 years of experience providing tax planning and compliance for privately held businesses and their owners, with a focus on manufacturing, distribution, and construction industries. Today, Christopher and Greg will hone in on the major tax provisions included in recent COVID-19 legislation that will impact the cash flow for small to mid-sized businesses and individuals. They will also discuss how recent provisions put in place will interact with other non-tax provisions of COVID-19 legislation and the impact that it will have on businesses. And now I'm passing it on to you, Chris.
Thank you, Imani. And good afternoon, everyone, and thank you for joining us. Happy Tax Day, although not really. What we wanted to do, if we can advance the slide, is for the first part here is cover several items which you may have been reading about in the news over the last several weeks, just to set the table for the rest of the presentation today. First and foremost, today is not a filing date. Hopefully everybody is in the loop on that. The IRS has extended the filing date to July 15th, as well as the payment date. So there is absolutely nothing due today. That not only is that for 2019, but it is also for estimated tax payments that would otherwise be due today, Q1 for 2020, as well as the Q2 payment has also been extended to July 15th. So good news there in that regard for, I suppose, the rest of you. For us in the tax profession, it looks like our busy season will continue for a little longer. Also, I wanted to point out a couple things, and we'll talk about it later in detail, but the IRS also extended various time-sensitive acts that may have come due between the period between April 1st and July 15th, and those things have been extended to July 15th as well. Among those would be the, for C corporations, a Form 1138 filing with regard to a deferral of paying 2019 balances otherwise owed with the corporate tax return when there's an expectation of having a loss for fiscal year 20 or calendar year 20 that ultimately would be carried back to 2019. So lots of things got extended, and summarize that nothing to worry about today in terms of postmark, payment, filing, etc. That doesn't mean we want to wait until July in terms of at least getting the stuff done. So please take it easy on us and help us out and continue to gather your information and send it in the short run so that we can at least get it prepared for you, and we're ready to go by July 15th. So with that, next slide.
All right. So, there's been such an enormous amount of legislative activity over the past few weeks. Can obviously make it pretty difficult to keep everything straight. So we thought it would be a good idea to go over kind of a high-level timeline of the legislation to date and, kind of set the table for what we'll be focusing on in this webinar. So this legislation really has been rolled out in three phases. The first phase was on March 6th, which was entitled the Coronavirus Preparedness and Response Act. And this act was basically an emergency spending bill that appropriated funds to certain government agencies. It did add some funding for the Small Business Administration, but that was, strictly related to some existing loan programs that they had. So there really wasn't too much in this legislation that impacted us as tax professionals. So I think a lot of us, did not pay much attention to this phase. Next slide, please. So then we got phase two, which was the Families First Coronavirus Response Act on March 18th. And this essentially provided relief to those who were directly impacted by the virus. This was in the form of expanded paid FMLA benefits and mandatory paid sick leave. So it's important to point out this was really intended for people who were impacted and couldn't go to work because they either contracted the virus, potentially had to care for family members that contracted the virus, or had to care for children who were at home now because their school or daycare closed. This is mandatory for all employers with fewer than 500 employees. There is a very narrow exception that was tucked in to this, that for employers with less than 50 employees, they can request an exemption, but they can only request this if they can prove that compliance with the program would jeopardize the viability of the business. So in that regard, I haven't seen a whole lot as far as how you would prove that case and what you'd have to do to qualify for that exemption. The good news is that they don't expect the employers to come out of pocket to make these payments. There is a payroll tax credit available. So basically, the payroll tax credit would equate 100% of the amounts paid for the family leave or paid sick leave under this program. So the net effect would be zero cost to the employer. And we'll talk a little bit later in this presentation as far as how those payroll tax credits interact with the other payroll tax credits and how to claim those. Next slide, please. So most recently, we have phase three, which is the CARES Act. And this included a number of tax provisions and a number of non-tax provisions. This was passed on March 27th. It provided a lot of funding for various loan programs, certain bailouts for industries, state and local government funding, hospital funding, most notably the Payroll Protection Program loan program that came out. That's been the hot topic over the last couple of weeks. Also included in this bill were the expansion of unemployment benefits to individuals who typically wouldn't qualify for unemployment, so independent contractors, gig economy workers, those types of individuals. The stimulus payments for individuals was also included in this package, and we'll touch on those in a later slide here. But mostly what we're looking to focus on in this presentation would be this last bullet point, some various other tax-related provisions that are tucked into this legislation. And what you'll see is a lot of these tax provisions either delay or they modify some of the revenue-raising provisions that were included in the Tax Cuts and Jobs Act. So, the format for a lot of what we're going to be discussing is here's what the law was under the Tax Cuts and Jobs Act, and then here's how the CARES Act might modify that or expand that. Then, of course, this begs the question, here's phase three. Is there a phase four, and where are we at with that? And from what I've read so far, I think a lot of us are still trying to work our way through the CARES Act. But what I've read so far is that, phase 4 is likely on the way. One of the things that has been discussed is additional funding for the payroll protection program as part of this. I haven't really seen too much in the way of additional tax-related provisions, but I would like to throw it to Chris too, if you have any comments on what you're seeing, or if there's any other items you're seeing discussed out there related to a phase 4.
Yep. So phase 4 is hotly being debated right now in the halls of Congress and with the Treasury Secretary. What we know is that in first and foremost, phase 4 is needed to top off, if you will, the money available under the Payroll Protection Act program. That's the free grant money that is available to businesses based on payroll. So originally it was $250 billion. It's projected that money applications have been submitted to tap that initial funding out, I think, by tomorrow. So phase 4 is an additional $250 billion for that. And then what various members in Congress are hashing out right now as a part of phase 4 is what are the compromises and additional things that are going to come along with that. There are, I think, Nancy Pelosi and Chuck Schumer are looking for an additional $250 billion for hospitals and state and local governments. As well, I've seen something pop up over the weekend that some members of Congress are not happy with a provision that we'll talk about later under the phase 3 with regard to the removal of the caps on individual taxpayers and ability to deduct losses on their personal returns. At this point, it's only rhetoric and saber rattling, if you will. We'll have to stay tuned to see what happens with that, and if there's any changes or clawback, if you will, to maybe things that might have been passed as a part of phase 3. So, if nothing else, it reminds us that everywhere you look, it's a time of uncertainty and things are changing day in and day out, not only in the tax world, but in what I'll say is the real world and everything else. And so we just have to take one day at a time and go from there. Next slide. So economic impact payments, part of phase 3. This is the stimulus checks and various other terminology used. So as a reminder, this would be $1,200 per individual, $2,400 for married couple, $500 per qualifying child under the age of 17. Those payments are subject to a phase out. If you're single, between $75,000 and $99,000, that $1,200 phases out. Likewise, married filing joint, the benefit phases out between $150,000 and $198,000. Those payments are being deposited and being sent out. I've heard from several clients and friends that have had money deposited here in the last 24 hours. I think it's the IRS's goal to have these payments paid out to those that are eligible no later than the end of this month. Couple things with regard to that. So if you have seniors that maybe didn't have a filing obligation previously, the preferred method of getting these payments in taxpayers' hands is direct deposit. So the IRS has established a couple of links that are referenced here on the slide. First one would be for those that haven't previously had a filing requirement because they didn't earn enough to have to file a tax return. They can go and enter their information there to get a direct deposit. And the second link provided would be for those that have filed and have paid in the past, but haven't wanted to give their bank account information to the IRS previously. And so there's a way you can do that now if you so desire. Ultimately, if you don't do that, at some point they'll send a check. I'm not sure at what point they do that. But if you don't provide your bank information and you are otherwise eligible, they will ultimately send you a check. They will, it's my understanding, they are mailing out letters to those that have received the direct deposit to let them know that the money was deposited into an account and approximately what day that would have been, so that you can match that up to make sure that it went to where it was supposed to go. And I guess final comment on this, maybe a couple final comments. And this could be a part of Phase 4, maybe not. I guess we'll have to see. There was a potentially big group that was left out of being eligible to receive payments, and that would be the so-called young adults between the ages of 17 and 24 that are, in college, living at home, still a dependent of their parents. They are not eligible for any payment under Phase 3 on this as well. There could be a group of, again, falling under the if you can qualify as a dependent of another, then you're not eligible to receive a stimulus payment. And that might be somebody like an elderly parent where their kids, adult children, are taking care of them, and they've been left out of this as well. The way that this works in terms of qualifying, it's based on your 2018 or 2019 adjusted gross income, depending on whether or not you filed your 2019 return yet or not. That analysis, in all likelihood, has already been done since the payments are coming out. So if you haven't filed your 2019, it's based on 2018. Ultimately, the way this will roll out is it's a benefit that will show up on your 2020 tax return if you file. And what will happen is ultimately, if you should have received more than you did, then you'll make up that difference when you file your 2020 tax return. On the other hand, as it's currently drafted in law, if you received more than you should have, then there is no requirement to pay that back to the government. Next slide. So the focus of the presentation today is all about generating cash flow in terms of the tax provisions in Phase 3 of the CARES Act that came out. And so really that's focused on and summarized here in this chart, where we talk about how quickly can we generate cash flow to get into the hands of business owners, whether that's in the C Corp return as the business, or whether that business is operated as a pass-through as an S Corp or partnership. And so the benefits are flowing through to a individual business owner's tax return. Some of the provisions have the ability to amend prior year returns. Those are referenced in green here in the topics in the columns we'll talk about. And others are what we call current year, whether that might be something claimed on a 2019 return that hasn't been filed yet, or will be a part of 2020 tax returns, like quarterly payroll returns where you're claiming tax credits, or if you're getting an advanced refund of payroll credits, you're filing the special form that the IRS created to do that, and we'll touch on that later. Next slide. And one more, please. Okay, so first and foremost, in terms of generating cash flow, we wanted to cover the fix in the so-called depreciation glitch that happened as a part of the TCJA, the Tax Reform Act that was passed at the end of 2017. And what happened was the definition of qualified improvement property that had been enacted actually prior to 2017 and allowed for a shorter life with regard to improvements to commercial buildings that were made after the building was placed in service. So you've had a building that you've been using for a while, and maybe you're renovating the interior. That's what we're talking about here. And so prior to the rules for qualified improvement property replaced what was in the code prior to that, which were really three different categories: so-called qualified leasehold improvement property, qualified restaurant property, and qualified retail improvement property. It kind of got rid of those three prior classifications and melded them all into one bucket called qualified improvement property. Again, it was beneficial because it provided for shorter life, 15 years versus 39. Prior to Tax Reform Act, the 15-year property was eligible for 50% bonus depreciation on the cost of the property when it was placed in service, versus 39-year life, which is basically depreciated on a straight line basis over a very long time. What happened with the Reform Act was there was a glitch in the language, and basically it was left out of eligible property for a 15-year life. And if you can advance to the next slide. So what that meant was it wasn't eligible for 15 years. It had to be depreciated over 39 years, and that applied to 2018 calendar year. Really, the first year of the tax reform was effective for. And the IRS had come out at the time, and despite the fact that everybody knew, hey, this was a mistake, it was a drafting error, and we really intended all along for this to be 15-year property and eligible for now 100% bonus depreciation, so full write-off in the year that it was placed in service. The IRS came out and said, well, our hands are tied. We really can't go with, yeah, that's what you intended. You have to actually, Congress, fix it. And until you do, the law stands as it is. It's 39-year property. So I know as a firm, we filed tax returns for 2018, and if we had qualified improvement property, it was depreciated over 39 years. And so now an opportunity exists because they fixed it and patched it, if you will, retroactively. So as if it was as intended as of 1/1 of 18, that it's 15-year property, it's eligible for 100% bonus depreciation. And the magnitude of that can be demonstrated in the last bullet point on this slide, where if you just have an example of you had $10,000 in improvements that were placed in service on January 1, 2018, we filed that tax return. We depreciated that property over 39 years, and you took a deduction for $246 in your tax return. Now we can go back and amend that return and take the entire amount, the full $10,000, which if I do my math right, that's an additional $9,700 and some change in additional depreciation. So it's likely, and this is the first step in the analysis, that for the rest of the cash flow opportunities, at least with regard to net operating losses, because this could, in fact, it'll do probably one of two things with regard to the 2018 return. It will either decrease the amount of tax owed and thus a refund for that difference, or it may create a loss for 2018, which can be carried back, that Greg will talk about here in the coming slide. So it's definitely something we want to look at, that you need to look at, and it's really the first step in the process for determining, how much cash flow can I generate here from these tax planning ideas. And let me go to the next slide.
All right, yeah, so as Chris mentioned, a lot of these provisions are going to interact with one another. So, as you're making decisions, you have to kind of look at them in total and what the net effect is after considering everything, and what that impact might be. So with regards to changes of the net operating loss rules, I'll actually go back briefly. Prior to the TCJA, the general rule was net operating loss could be carried back 2 years and then carried forward 20 years. And that carryback's generally automatic. So if you don't want to have the carryback, you would have to do an affirmative election to forgo the carryback period. And then under the prior law, those carry forwards could offset 100% of the taxable income in a future year. Then when the TCJA came into play, it eliminated the NOL carryback for losses generated in tax years ending after 12/31/17. So effectively beginning for the 2018 year, there was no longer an NOL carryback. They did provide for an indefinite carry forward of these NOLs, but it could only offset 80% of the taxable income in any future year. So you couldn't fully offset taxable income in a future year with these NOL carry forwards. So then the CARES Act came into play and modified a few things. First, it provides for a 5-year carryback period for NOLs generated in tax years beginning after 12/31/17 and before January 1st, 2021. So you're talking about calendar year taxpayers, that would be 2018, 2019, and 2020. Further, it temporarily removes that 80% limitation for NOL carry forwards, so they can fully offset income for tax years beginning before January 1st, 2021. And one thing I wanted to point out was that these provisions actually apply to both, corporations and individuals. So if you have pass-through losses flowing through to individual returns that creates an NOL, these provisions would also apply to individuals. Next slide, please. One other thing that was included in the CARES Act is another technical correction to the TCJA for fiscal year filers. So this is dealing with taxpayers who had fiscal years that straddled December 31st, 2017. And because of the way that the TCJA was worded, it had actually eliminated the prior law carryback for those taxpayers that were effectively filing 2017 returns, but it was a tax year that began in 2017 and ended in 2018. So the CARES Act corrected that and clarified that those fiscal year taxpayers are eligible for the 2-year carryback period and the 20-year carryback or carry forward period under the pre-TCJA law. So that's limited in scope to certain fiscal year taxpayers, but it could be something that's advantageous. And of course, with all these changes, we were asking, for further guidance because we need to kind of know what the procedures are and how we tie everything together for taking advantage of these carryback periods. And we actually got a lot of guidance late last week in the form of a couple pronouncements, which we're talking about on the next slide here. Next slide, please. The first was Revenue Procedure 2020-24, which provides the procedure for waiving the 5-year carryback period for NOLs arising in 2018 and 2019. So, like I was saying, under prior law, the carrybacks are basically automatic unless an election is made to forgo the carryback period. So if you had a taxpayer with an NOL in 2018 or 2019, they wouldn't have made an election to forgo the carryback period because at the time of the filing, those didn't exist. So now that they retroactively changed the law, basically an affirmative election is going to be made if you want to forgo that carryback period. The good news is they are allowing you to make that election on your next tax return that is due after the enactment of the CARES Act, which for calendar years taxpayers, that means 2020. So if you had a corporation that had NOLs in 2018 and 2019, you can attach separate elections to the 2020 return when you file that to forego those carryback periods. And once the election is made, it's irrevocable. One other provision I'll touch on quickly here is this revenue procedure also allows the taxpayer to elect to exclude years from the carryback period in which Section 965 applies. So this was the one-time transition tax as it relates to earnings of foreign corporations. For most taxpayers, this was an additional amount of income. If it had applied, it would have been picked up in the 2017 tax year. So basically what this does is say that if you utilize the carryback period, you can skip the tax years in which you have the 965 transition income to avoid dealing with the complexities that would result in that calculation. So that's good news for taxpayers.
Yeah, Greg, if I could, in really, what the what the law says on that is that in fact the election will be deemed to be made when you do that, and that actually is beneficial for taxpayers, even though it may not seem so. But the rate of tax on that 965 foreign income, that their repatriation tax, is actually at a like 15.5% rate, and so in that regard, you want your NOLs, to be utilized at the highest rate that's possible. And so by, if you will, not allowing taxpayers to soak up this tax with the carrybacks, it allows those losses to carry forward into future years in offset tax that's at effectively a higher rate, which for years prior to 2018, at least for C corporations, for most corporate taxpayers, the maximum rate was 34%, and for individuals, 39.6%. So it's actually a good thing.
All right, thanks, Chris. Next slide, please. The other form of guidance that we got was Notice 2020-26 that provides an extension of the deadline for filing the tentative carryback adjustment application. And this is for NOLs arising in tax years beginning in 2018 and ending before June 30th, 2019. So if you think about it in context of a 2018 corporate return with an NOL, if you wanted to file Form 1139 to claim a refund, a carryback refund, it would typically be due within 12 months of the close of the taxable year. So this would have already passed. It would have been December 31st, 2019. And this notice grants a 6-month extension until June 30th. This slide should read June 30th, 2020 is the due date for making that, or for filing that form. So really, this is one of the more time-sensitive, planning opportunities here is if you have a corporate return with an NOL, and you may potentially be amending that corporate return as well for some of these other provisions that would need to be done, and the Form 1139 would need to be filed by June 30th. And generally, you would still have the option to go back and amend a prior year return for the carryback claim, but the Form 1139 is preferred because it results in an expedited examination and processing, which is typically 90 days of filing. The notice also clarifies that a corporate taxpayer may use the Form 1139 to claim a full refund of AMT credits under the new CARES Act provisions, which we'll touch on that in a future slide here. But basically, a single 1139 can be filed to claim both the carryback and the refund of the AMT credits. And one other interesting thing to note here with the Form 1139 filings is that these are typically paper filed, and now that the IRS has closed down all service centers, kind of creates a problem because there's no one there to accept these returns and process them. So over the weekend, the IRS had released temporary procedures for filing these, and it's under the COVID area on the IRS website, but there's essentially a special fax number that we're supposed to use to fax these forms in once complete. All right, next slide, please. And here's a handy chart that just kind of shows you the breakdown between when the NOLs generated and what the rules are related to those NOLs. Next slide. And briefly, it kind of ties in with the corporate NOL piece. The alternative minimum tax relief that was part of the CARES Act. So if you go back to the enactment of the TCJA, the corporate AMT was repealed, and any taxpayer that had previously paid AMT would have, AMT credits that were rolling forward. Well, those are now refundable, and they were refunded over a series of years, with the last refundable payment coming in 2021. The CARES Act essentially just speeds up that timeline, saying that any unused minimum tax credit would now fully be refundable in 2019. If for some reason you might be able to claim it sooner by filing the 1139, you can claim 100% of the refundable amount for 2018 by going through that process that we had previously touched on. All right, next slide, please.
So that was a whirlwind tour through the loss carryback provisions. So some sensitive dates there. That chart pointed those out. Take a look at that. I don't know why, it doesn't make a lot of sense to me, but the unique situation where you had the fiscal year that started in 2017 and ended in 2018. If you have a loss now for that year, we can carry it back 2 years. The 1139 filing to do that is actually not due until July 27th of all dates, which is 120 days after the date of the CARES Act. And for some reason, in fixing that, I exposed that glitch in the tax reform. That's the metric they came up with. I don't know why you wouldn't tie the two dates together for NOLs generated in calendar years 18, 19, and 20 that are due June 30, but they didn't, at least not yet. So something that we'll be paying attention to, and when you hear from us, that you'll know why in that regard. One other maybe comment just to point out on carrying back the losses for 5 years is to keep in mind that for whatever reason we have short tax years in that 5-year period, that short tax years count as one of the 5. And so it's not necessarily 5 calendar years if you have a situation where you had a couple of short tax years in that carryback window. So moving on to the payroll taxes and credits and deferrals in the next couple of slides. So this is kind of in conjunction with the credits that were enacted as a part of phase 2 with regard to funding payroll to incentivize and help employers keep their employees employed and on the payroll, regardless of whether they were actually able to work or not. So this first item here, we've phase 3 deferred the payment of employer payroll taxes for wages paid March 27 through December 31, 2020. This is the employer's share of the FICA taxes, 6.2%. There's no limitation as to the size of a company with either regard to headcount or whether they were impacted or not by COVID-19 or what their sales revenue is. Generally, any employer is eligible for this. And what are you getting? Well, you're getting a deferral of when you have to pay that portion over to the government. And so basically, it's 50% of that amount is due on December 31, 2021, and the balance is due December 31, 2022. The only exception in terms of who's eligible would be with regard to a company that received money under the Payroll Protection Program, the so-called grant helicopter money. And if you receive that money, then you are not eligible for the deferral. The issue is because this deferral applies to wages paid starting March 27th, if you ultimately get money under that PPP program, the ability to defer payroll taxes stops basically as of the date it's deposited in your account. Any wages paid prior to that are still eligible for that 50% deferral through 2021 and the balance in 2022. The IRS has some FAQs out on their website with regard to the interaction of this and how that works along with some of the other credits. And if we go to the next slide, please. Employee retention credit. So this does have some restriction or requirements around employers and who's eligible for that. Basically at the bottom of the slide, the employer has to fit into one of two categories. Either they were required to suspend operations either fully or partially by government order, or the most obvious type of business for that would be restaurants who had to stop dine-in service that can only offer carryout, or the business has suffered an economic impact based on the measurement here on the slide, and if you fall into that bucket, then you're eligible. And what do you get? So you get a payroll tax credit, 50% of the first $10,000 paid to employees, so it's a maximum of $5,000 between, what are the dates here? Between March 13th and December 31, 2020. So if we can go to the next slide. Really, there's no size requirement on this, but so if you have more than 100 employees, in terms of the measurement of the wages, that's where it comes into play. If you have less than 100 employees, then all of your wages of your employee base can go into that computation. If you have more than 100 employees, then it's only the wages of those employees who were not working that you can count for purposes of the credit. And again, the point behind this is where government is fronting you money as a business to in the form of a payroll tax credit to keep your employees on payroll. Next slide. If for some reason because of the interaction of some of the other credits under phase 2, you've run out of money that you actually owe the IRS in terms of payroll taxes filed on your 941s, there is the ability to request advance payment of these, so they are refundable. And there's a special form that the IRS came out for that, and there's some links here to find that. The one big caveat on all of this in terms of eligibility for this credit is if you have received the Payroll Protection Act program loan or the SBA disaster loan, two different programs, but if you've received money under either of those two programs, you are not eligible to claim this credit. And at this point, that's the guidance that's out there. There may or may not be an update in the future on, does it truly make you ineligible, period, or does it only make you, ineligible for the time that these loans are in place? Because the PPP loan is for funding payroll essentially for the next 8 weeks. But at this point, there's no guidance to say otherwise. It's if you got the money, you can't also claim the credit as of today. Again, this is for a credit for for retaining your employees. So they have to be employees. You can't have laid them off and fall out of the definition of an employee. Next slide. So this is just a screenshot of the 7200 form which is the advanced form to claim the advanced payment of these payroll taxes if you run out on your 941. The default method is, as you file your quarterly payroll taxes, you'll take a credit against what you otherwise owe the IRS on your employer share of the FICA taxes, and that's how it's reimbursing you. If you owed $8,000 but you had $5,000 in credits, you only have to pay the IRS $3,000. Likewise, where this form comes into play is if you are eligible for credit of $5,000, but you only have $3,000 that is otherwise owed, then you can file this form to claim the $2,000 difference and get it back sooner. Next slide.
All right, so additional changes were made under the CARES Act to the business interest expense disallowance rules under 163J. Now, these rules really only apply to larger taxpayers for the most part. There's a gross receipts test where if your average annual gross receipts for the previous 3 years was under a specified amount, which was set at 25 million and then indexed for inflation, the amount I think was 26 million for 2019. If you're under that amount, these rules generally would not apply to your business. There are some exceptions to that, but that does kind of limit the scope of who's impacted by this provision. So under the TCJA rules, there was a limitation on deductible business interest expense, and it basically amounted to the sum of interest income for the year plus 30% of the taxpayer's adjusted taxable income plus floor plan financing interest for the tax year. And most taxpayers fell into the 30% of adjusted taxable income threshold. So basically adjusted taxable income was you take your taxable income for the year and add back certain items such as depreciation, amortization, net operating losses, any non-business income or deduction to arrive at this. So it's a number that's similarly equated to your EBITDA for the year. So you're limited in deducting business interest up to 30% of that number, or over 30% of that number, rather. Then any business interest that is not allowed as a deduction under these rules, it would be carried forward indefinitely, and you could potentially utilize those carry forwards in a future year. Next slide, please. So under the CARES Act, they expanded this limitation. They increased it from 30% to 50% of adjusted taxable income. This applies for taxpayers other than partnerships. It applies for the 2019 and 2020 tax years. So this one doesn't go back to 2018. It starts in the 2019 tax year. Then there's special rules for partnerships where it only applies for the 2020 tax year, essentially, which I presume is just to limit the administration of going back and amending partnership tax returns for this change. So what they did do, because they didn't allow you to go back to 2019 for partnerships, is they included a special provision where on your 2020 return, partners who have carryovers of interest expense from 2019 get to take 50% of that as a deduction. It's fully deductible in 2020, and then the remaining 50% would be subject to the normal limitations for that year. Next slide, please. And there are various elections that go along with this. You can elect out of using the 50% of ATI rule. And in addition, partnerships may elect to use their 2019 ATI adjusted taxable income amount instead of 2020. The idea there is if you're truly impacted in 2020, your 2019 ATI is going to result in a larger deduction. And there's some elections made regarding this as well, which we go over in the next slide here. Next slide, please. And we did get some guidance on how to make some of these elections, and I'm not going to go through all these in great detail because of the limited applicability, but one of the things that is covered in Revenue Procedure 2020-22 is situations where an electing real property trader business may have made an election out of these rules. And without going into great detail here, the change to the QIP rules, the Qualified Improvement Property rules, would really impact whether or not a real estate business would have wanted to make this election. So this revenue procedure kind of outlines how you can make a revocation of that earlier election and how you go about doing that and calculating, the prior year return. It also includes the provisions for electing out of the 50% ATI limitation, the election to use 2019 ATI in 2020, and if you wanted to elect out of that 50% rule for partners and partnerships, there's also a special election in there for that piece. Chris, do you have anything to add on this?
I don't. It's highly technical and specialized, but if I guess the takeaway would be is if you were impacted and were subject to these rules previously, you're a client of Ray and Associates will likely be in touch with you to go over your options and what might be best with regard to these elections.
Okay. All right. Next, we're going to get into a few of the individual tax provisions. So here we have one that might be limited in scope, but it could have a big impact on certain taxpayers. And this is the change related to the 461L rules, which were loss limitations for non-corporate taxpayers. So the TCJA implemented the limitation on the ability of individuals to utilize business losses to offset non-business income. So this would mostly apply to owners that are owners of pass-through entities that get losses passed through on a K-1 or single member LLC, sole proprietor type businesses. And what the limitations only allowed up to $250,000 of the non-business income for a single individual, or $500,000 if married filing jointly. And if there was any loss that was limited by these rules, the excess would be treated as an NOL that carried forward to the next year. So the CARES Act basically comes in and delays the application of this rule until 2021, and it makes a few technical corrections to the calculation. So basically the takeaway here is any taxpayer that was subject to this limitation in 2018 or 2019 will want to amend their tax returns in order to claim that additional loss in that tax year. And further, it could potentially create an NOL situation where you would be able to utilize the 5-year carryback provision. So it could be meaningful for certain taxpayers and result in some generous refunds. As far as the technical corrections, the highlight of what was changed was that the CARES Act clarifies that wage income will not count as business income. So that effectively means you can't use these business losses to offset your wage income, which was something that wasn't clear in the original drafting of the law. All right, next slide, please.
So the last couple of slides here, we'll move pretty quickly through the continuing on the individual side and cash flow related items. With regard to retirees and required minimum distributions, they did come out and suspend the requirement to take RMDs for 2020. Unfortunately, if you were somebody that gets yours at the beginning of the year, it's too late. If it's already been paid, you can't put it back, at least as we sit here today. So be aware of that. If you haven't taken it yet, make sure, and you don't need to take it, make sure you alert your investment advisor to hold that over for next year. There was also some relaxing of the rules with regard to qualified plans and taking distributions from them if you are younger than 59 and a half. Previously, there's a 10% penalty that applied to these so-called early distributions. Now you can do that up to $100,000. It's still subject to income tax, but they've also allowed you to pay that tax in pro rata over 3 years, presumably 2020, 2021, 22. Pay attention though, if particularly in these out years, if you take money out and later you didn't need it all, you can put it back. So, you know, as in get a do-over, so to speak, without any ramifications. And while there isn't guidance yet, presumably if you do that in one of the 2021 or 2022 and you've paid tax on a third of it in 2021, you'd be able to amend your return to get that tax back. Next slide. And with regard to the distributions, they've allowed who can get one in terms of the permissible ways to get distributions. So we've got diagnosed here. They're listed here on the slide here. I don't need to go into that any further. They've also increased the loan limit on qualified plans from $50,000 to $100,000. And increase the for the next 6 months. I guess we have to take if you need the money temporarily to do that. I think generally our retirement planning people say that's not a great idea, but if at the end of the day you're out of other sources for that money and you need it, you will pay interest on it, but you are paying yourself that interest in the end. So not the end of the world if that's your money of last resort. Next slide. And then, so I guess concluding here with changes to charitable deductions, you know, this really isn't necessarily a cash flow item with regard to you as somebody making the charitable deductions, but I think was probably put into place as part of the CARES Act to help the nonprofits that are out there and hit hard during this time and to incentivize taxpayers to continue their funding. So they've increased or actually got rid of the limitation on how much you can give if you're an individual to 100% of your adjusted gross income. For corporations, they've increased it from 10% of taxable income to 25%. They've also created a limited above the line deduction. So I guess as a reminder, under the current law, how do you deduct your charitable contributions? You do that as an itemized deductions, which you actually have to be itemizing, therefore, in order to do that. If you're not, then you're making those contributions purely out of the goodness of your heart because you're not getting any tax benefit for it. Now, under the CARES Act, there's a limited $300 that you're allowed to deduct what we say above the line, so against adjusted gross income. So you don't have to be itemizing in order to give away $300 to a qualifying charity here in 2020. And that qualifying charity is generally your 501c3 organizations, churches, and state and local governments. And with that, I think we're ready for questions.
Awesome. Thank you, Chris. So I'm going to get into the questions here. If we don't get to any of your questions, we will be sure to email you guys the response to those. So we're going to take an extra 5 minutes here. The first question I have is for Greg. It was, what was sub S tax return? Sorry, I said that completely wrong. Was sub S tax return filing extended?
So I think you're probably referring to the original due date of 3/15. Is that what?
I believe they are.
Because the extended deadline relief only applies to returns and/or acts that were due after April 1st, 2020. So partnerships and S corps, if they were due, 3/15 of 2020, would not fall under this automatic extension. So if an extension wasn't already filed for that, generally, then no, it wouldn't apply.
Okay, and then I have a question here for Chris. If a company has been awarded a PPP loan, can that same company apply for an SBA EIDL loan? And then this is a two-part question, so if you want me to repeat the second part, it's also, do you believe Congress is going to put money into the EIDL loan program to truly allow loans up to $2 million?
Yeah, so the answer to the first part is yes, you can get loans under both programs, I believe. It's not mutually exclusive. It's important to note and we've covered those topics in other webinars and other thought leaders in the firm. And so there's resources on our website that should talk about that. So I would point them there as well for additional resources. I did see that the SBA is out of money under the EIDL, the disaster loans. So those are truly loans versus the PPP, which is can be forgiven if you meet the criteria. So first and foremost, I think they're going to go the top off the PPP, and but it's conceivable, particularly if things don't turn around in the near term, that they may also have to fund the EIDL program as well.
Great. And the next question I have here is for Greg. Can you carry back a corporate loss to 2017 when the corporate rate was graduated up to 35%?
Yes. Yeah. So that falls within the 5-year carryback period. Now, presumably, you go back to the earliest tax year you possibly could to take advantage of it, which is typically what you'd want to do, just based off that year being closed really for all other purposes. So you would go for a 2018 return, you would go back to 2013 and then carry forward from there any unutilized amount. It would roll forward accordingly.
And then I have another question. Oh, go ahead.
I was just going to say that's one of the advantages when you evaluate this, is looking at those high rate tax years versus carrying it forward to a lower tax rate.
Okay. And then we have another question here. How do we challenge the determination on the impact payments? And that can be for either you or Chris.
Did you say, how do you challenge the determination?
Correct.
Yeah, so I don't believe there's any challenge to the determination. You're going to get what you got. If that was zero, then ultimately that will play out when you file your 2020 tax return, and presumably based on the criteria in 2020, if you're eligible for something, you get it then. That's at least where we sit today.
Okay, and then I have a question here for you, Chris. Can you clarify if an employer receiving a PPP loan can defer 6.2% employer payroll tax until the loan is officially forgiven, or cannot defer at all once funds are deposited?
Yeah, so it was unclear as late or as recent as 10 days ago on that. But the IRS has come out with FAQs that have cleared it up, and you are eligible for the deferral until, on any wages paid between now and the date the loan ultimately is forgiven. But after that date, so once the bank forgives the loan, from that date forward, then you are no longer eligible for the deferral.
Great. And then I have a question for Greg. Do we know when access will be updated for the increase from 30% to 50%, for the 163J business interest rules?
That I don't know. I know they come out periodically with their notices of when the software updates are set to happen. I can ask that question internally here if any guidance has come out from Access, but I haven't seen. I think they're already behind in updating for the due dates and the extended due dates. So it might be a while before those other provisions get updated in the system.
Great, and then I have 2 more questions here, and then we'll wrap it up. This can be for either you, Greg, or Chris. If I applied for a PPP loan, am I able to defer payroll taxes up until I am notified for the forgiveness status of my PPP loan, or can I only defer until I receive the PPP funds?
No, it's you can defer until the bank tells you that your loan is forgiven. So if you pay $10,000 in wages between now and, let's say, May 1st, and on May 2nd the bank says the loan we gave you is deferred, or is forgiven, that $10,000 that you paid you can defer the payroll taxes on that part of it, and then any wages paid after May 1st, in my example, you are not eligible for deferral.
And then if you get a PPP loan and it is forgiven, is it considered income? If not, what is it considered?
So go ahead, Greg.
Oh yeah, so this is it's explicitly not taxable income in the CARES Act. So they do clarify that it won't be considered taxable income, the amount that is forgiven. I think there's some clarification that's needed on how that's going to be treated, essentially for book purposes and maybe even financial statement purposes if you have financial statements. But it is clear that you won't be taxed on that income.
All righty, and that was the last question that we're going to do for this session. Any question that we didn't get to, we'll be sure to reach out to you guys afterwards. So thank you for joining us for today's webinar, What is Life After Coronavirus? New Tax-Related Provisions for Increased Cash Flow. We hope Christopher and Greg were able to provide you with some valuable insight that will help you make sense of the current government recommendations stemming from the COVID-19 crisis. If you sign up today and realize that you have additional questions, you're always welcome to reach out to Christopher and Greg directly. You can also contact any of our RAY team members from the firm's website at www.raycpa.com. That's REA. Don't forget to watch your inbox for an evaluation survey, access to the recording of today's webinar, and more. Thank you again, and we hope you have a wonderful rest of your day.